Hello and welcome back to Core Finance. I'm joined today by Marc Ostwald, who's the strategist at ADM. How are you today, Marc?
I'm very well, thank you.
Good. Well, thank you for coming in on a Friday. We're going to talk about the euro, but the euro not versus the dollar, versus the
Chinese yuan. Well, it's interesting from the aspect that obviously this morning we've had an official comment from a gentleman in SAFE, the organisation which oversees the Chinese yuan in official terms, talking about the fact that there may need to be a reserve requirement cut for the banks in China because of the strength of the yuan, but it's the strength of the yuan against the dollar. The interesting aspect in all of this, of course, is it is solely against the dollar, which really highlights that strength in the yuan is not yuan strength, which it looks enormous, and obviously we've gone through those key levels back from early in March today. It's not actually yuan strength, it's dollar weakness, and that's an important aspect to remember. I think more importantly is the other aspect of some of the comments that we got from Mr. Draghi yesterday. Now, I can certainly understand the aspect that the ECB is concerned about the relative strength of the euro in terms of the impact it has on prices. That's proven. It will push down on import prices, and that will feed through into lower inflation, which makes the ECB's task that much more difficult. Even though I'd find an interesting counterpoint to that in the comments that we had from New York Fed's Dudley yesterday, who, in contrast to a lot of his colleagues, says he still feels comfortable with the Fed's rate hike trajectory.
Still very hawkish.
Still very hawkish, and he made some interesting comments on inflation because he said, well, it may not be transitory, but it may be actually a positive structural development, insofar as that might mean that you could probably have a higher resource utilization above all in terms of the labour market, and be less concerned about it. But then he went on to say, and I still feel comfortable with the rate trajectory, which is definitely not what his colleagues are saying. But bringing that back into context of the ECB yesterday, obviously Mr. Draghi made those comments about the downward, they have to factor in the downward pressure on inflation from the euro. But on the other hand, he also then threw out that old chestnut that we have all the time from central bankers all over the world, that a strong currency is basically going to create problems for exporters. Right, well, let's have a look at that euro-yuan chart and then have a little bit of a think about what's been happening with EU exports, but above all, Eurozone exports to China. They are booming. If you read any of the BGA in Germany, the Exporters Federation, or indeed the Italian Chambers of Commerce, they're all basically talking about huge demand from China. And that would obviously be hampered by this much, much stronger euro that we've got against the Chinese yuan. And I think that's actually very, very significant because it really shows, well, I suppose you could argue to a certain extent, because China's still very much a developing economy, and some of the things that they want, particularly in terms of heavy industrial machinery, are perhaps only made in countries like Germany.
Yes.
But I think that's only at the margin. You would think actually it would have some impact. I would suggest that actually exports are far less sensitive, and you can look at the history of particularly UK exports, which interestingly we've just had the UK trade data, still no sign of any benefits from a weaker sterling, and indeed German exports, and the worst event for German exports was reunification, which had nothing in, and at the time of German reunification, the first 5 years afterwards, the Deutschmark was actually particularly weak. So this is a bit of a myth. Nevertheless, I think it tells us a couple of things. First of all, the Chinese are probably using that dollar strength, or rather dollar weakness at the moment, to up their imports of commodities, which is seen as good, very positive development for the global economy. It also underlines that the underlying pace of the Chinese economy is actually still very, very solid. And the fact that we're seeing much less in the way of fluctuations in Chinese money markets the PBOC has it much better under control in terms of the ins and outflows, is also a positive development. It doesn't mean that the credit problem that China's built up has gone away, but it does tend to sort of lean against the idea that we're headed for some sort of catastrophe, particularly in terms of the fallout for the rest of the global economy. I'd suggest that is not the case. But bringing this back to the euro, I think the most interesting development that we've had this morning, after what one would call a biggest attempt by Mr. Draghi yesterday to offer zero clues about what is this floating of balloons about what they might actually do. So he said they'd had some initial discussions, and I think markets were probably thinking, well, it sounds from the way he's talking about things that they don't want to be too aggressive about things. Perhaps he didn't mention this, and we've had it floated via an idea, because it does actually sound a lot more aggressive than I think most people in markets have been assuming. Apparently, the options on the table are either a cut to 40 billion from the current 60 billion,
yep,
or down to 20 billion, which would be far more aggressive,
indeed,
for a term of 6 or 9 months in combination. So it could be any of those 4 options. But that's all in all, a rather more aggressive stance. But as much as obviously it will be seen as a green light to buy the euro by some, I think one perhaps needs to also remember they're not talking about rate hikes. This is just removal of some accommodation at the end of the day, which, from the aspect that they're not buying longer term bonds, will tend to put some upward pressure on Eurozone yields, above all in Germany. And therefore, in the current environment with the market doubting the Fed, you would see that 10-year Bund, 10-year US yield spread probably narrow a little bit further, which would be a positive for the euro. It certainly has been. At the peak, at the beginning of the year, the peak of the Trumpflation trade, we got the spread as wide as 235 basis points, which was worth talking about. Now it's down to 175 basis points, which is still handsome when you're getting next to nothing in the Eurozone, but not nearly as attractive as it was. And there are other options, particularly when one looks at the likes of Canada, which are perhaps more interesting. But that 10-year Bund, 10-year US Treasury spread is the one to watch, particularly from the aspect of, will we see markets get more positive about the US economy, which they should be doing, but will that positivity in yield spread terms actually probably be negated by the fact that there is some upward pressure on Eurozone 10-year yields? And that's going to be the one to watch over the next couple of months.
Fantastic. And bringing that all together, what's the trade at the moment? Should you be buying the DAX? Should you be buying the euro? Where's the trade?
Well, certainly further euro strength is likely to be seen as an impediment to corporate earnings. I'm not 100% convinced about that, but it's very difficult to go against the consensus on this one. I think in actual terms, what you're talking about, referring back to what I was just talking about, is manufacturers in the Eurozone are actually going to see their input costs start to fall, and the euro strength should actually benefit them in the longer run. So I'm loath to lean against the market's tendency to basically go long a currency and short the equivalent equity index. But perhaps in this case, people need to think through that trade a little bit more. I think the key still in all of this is looking at positioning. We are already very long of euros. By contrast, and you're already seeing it with the yen below 108, we are also still quite short of yen, and it's that short yen position needs to be purged, in my view, far more significantly. Doesn't need to go positive, but it needs to be purged if we're going to have a meaningful dollar rally, which I still think is a possibility. It's more of a possibility. And in terms of risk reward now, we are basically discounting bad news on a permanent basis for the US and good news permanently for the euro. So, the risk reward skew is starting to go against you.
Understood. On that note, Mark, thank you very much for joining us today.